Uber's operating income just hit a record $1.923 billion. Yet net income collapsed 85%. How does a company post its best operational quarter ever while headline profit nearly disappears? The answer reveals something far more valuable than a single earnings report. It reveals exactly how professional investors separate signal from noise. And this is the core skill behind every sound investing strategy. Here is what actually happened. A $1.474 billion unrealized loss on equity investment revaluations, meaning paper losses on holdings that have not been sold, was booked below the operating line. No cash left the building, no driver lost a shift, no customer deleted the app. But because accounting rules require Uber to mark its investment portfolio to current market prices every single quarter, one rough quarter for those holdings wiped out nearly all reported profit. In Q1 25, those same investments generated a $51 million unrealized gain. That is a combined swing of approximately $1.525 billion between two quarters, with zero connection to Uber's actual business operations. Non-GAAP net income, which measures core business earnings, grew 39% year over year to $1.493 billion. Non-GAAP diluted earnings per share rose 44% to 72 cents. That is the real story, and that is where your fundamental analysis should begin. Now here is where it gets genuinely interesting. Uber's gross bookings, the total dollar value of all rides, deliveries, and freight processed on the platform, reached $53.7 billion in Q1 26, up 25% year over year. Total trips grew 20% to 3.643 billion. Monthly active platform consumers expanded 17% to 199 million users. By every volume metric, demand is accelerating, and yet total revenue grew only 14% to $13.203 billion. Why the gap? Management disclosed that business model changes reduced revenue growth by 9 full percentage points. The most striking example is in mobility, where gross bookings grew 25% to $26.394 billion. But mobility revenue grew only 5% to $6.798 billion. That is a 20-point divergence. This is something you can check for yourself in the segment tables of the earnings release. The critical question is whether this gap reflects a pure accounting reclassification or real compression in Uber's take rate from drivers. The full 10Q filing will be the decisive document. Meanwhile, something most surface-level analysis will miss is happening in delivery. Delivery revenue surged 34% year over year to $5.068 billion. Delivery gross bookings reached $25.992 billion, nearly matching mobility's $26.394 billion in scale. Delivery segment operating income grew 43% to $961 million. Think of it this way. Uber is no longer a ride-hailing company that also delivers food. It is becoming a dual-engine platform where both segments are approaching parity. For your stock market analysis, two large independent growth engines are structurally more resilient than one. That meaningfully changes the risk profile of this investment. Binding both segments together is Uber One. 50 million members now drive half of all gross bookings across mobility and delivery. That is not a loyalty program. That is a recurring revenue moat. Higher frequency users, stronger retention, and reduced sensitivity to competitor pricing. In value investing, the distinction between improving revenue quality and improving revenue quantity matters enormously. Uber One is delivering both. Now the cash flow puzzle, and this is where sophisticated investors must pay close attention. Free cash flow, meaning operating cash flow minus capital expenditures, is the clearest measure of real cash a business generates. Non-GAAP operating income grew 42% year over year, yet free cash flow grew just 2% to $2.286 billion. That divergence is the single most important analytical question in this entire report. The primary driver is a massive working capital swing. Accrued expenses and other liabilities moved by negative $541 million in Q1 26, compared to a positive $430 million contribution in Q1 25, a reversal of nearly $971 million in one quarter. Purchases of notes receivable surged from $40 million to $187 million. Non-marketable equity security purchases nearly doubled to $332 million. These are identifiable explanations, but the gap must close in Q2 if free cash flow does not re-accelerate toward $2.4 billion. Consistent with the guided adjusted EBITDA midpoint of $2.75 billion, that becomes a genuine red flag for your investing strategy. On capital allocation, Uber repurchased $3.011 billion of its own stock in Q1 26, a 69% acceleration versus the $1.785 billion repurchased in Q1 25. That buyback exceeded the quarter's entire free cash flow, funded by drawing unrestricted cash down from $7.105 billion to $5.558 billion. The current ratio, a measure of short-term financial flexibility, tightened from 1.14 times to 1.07 times. Management is betting aggressively on themselves. That signals conviction. But liquidity headroom is narrowing, and that pace demands monitoring. One liability deserves direct attention. Insurance reserves, funds set aside for ongoing legal and regulatory obligations, now total $12.904 billion, rising $441 million in a single quarter, with long-term reserves alone at $9.437 billion. They are growing, long duration, and difficult for outside investors to independently assess. Not an immediate threat, but a compounding obligation sitting beneath otherwise exceptional operational metrics. Here is the verdict. Gross margin expanded 520 basis points to 45.0%. GAAP operating margin hit a record 14.6%. Non-GAAP earnings are scaling at more than twice the rate of top-line growth. The perception gap between GAAP appearances and operational reality is precisely the opportunity that rewards rigorous fundamental analysis. If Q2 26 free cash flow confirms a return to proportional earnings conversion and gross bookings land within the guided $56.25 to $57.75 billion range, the market will be forced to reprice this stock to reflect what the fundamentals already show. The investors who recognize that before the crowd always generate the strongest returns. And this is the part that most people never reach. Not because the information is hidden, not because you need a finance degree or a Bloomberg terminal or 20 years of experience on a trading floor, because knowing what happened is only half the equation. The half that actually changes your life, the half that separates the people who watch history repeat itself from the people who see it coming, is understanding why it happened. The mechanism underneath, the incentive that was misaligned, the risk that was mispriced, the assumption that felt safe until it wasn't. That is what we just broke down together. And that framework, that way of reading a situation, does not expire when this video ends. It travels with you. Into the next financial video you scroll past on your phone, into the next conversation about whether now is a good time to buy or sell or wait, into the next headline designed to make you feel something before you have had a chance to think anything, into the next decision, big or small, where someone is counting on you not knowing what you now know. Here is the truth that every story we cover on this channel keeps pointing back to. Money does not move randomly. Markets do not collapse randomly. Companies do not fail randomly. People do not end up broke randomly. There's always a logic underneath, always a sequence of decisions, incentives, and miscalculations that, when you see them clearly, make the outcome feel almost inevitable. The tragedy is never the collapse itself. The tragedy is that the signals were there the entire time. Visible, readable, understandable, for anyone who knew what to look for. Whether we are talking about a trillion-dollar empire, a housing market on the brink, or the way a single household manages its monthly budget, the laws of gravity remain the same. You cannot build a skyscraper on a foundation of sand, and you cannot build a future on a foundation of financial illiteracy. That is the only edge that actually matters in the long run. Not a hot stock tip, not perfect market timing, just the ability to read the room before everyone else does. It is about shifting your perspective from being a passenger in the global economy to being someone who can actually read the map. Because when you understand the map, the scary headlines lose their power over you. You realize that most of the noise is just that. Noise, designed to keep you reactive rather than proactive. In the world of finance, the most expensive thing you can own is a closed mind. Most people lose money not because they are unlucky, but because they are operating on outdated maps. They are playing a game where the rules changed 10 years ago, but they are still following the old guidebook. By looking at the specific case study we discussed today, you've essentially just updated your software. You've seen how the gears turn behind the curtain. And once you see the machinery, you can never go back to just believing in the magic trick. The path to real wealth isn't paved with complex algorithms. It's paved with the patience to learn and the courage to act on logic when everyone else is acting on emotion. It's about recognizing that every financial disaster and every massive success is just a human story told through numbers. So if this video sharpened something, if it made one concept click that was blurry before, if it gave you one framework you will carry into a real decision, then you already know what to do next. Take that insight and apply it. Don't let it sit as entertainment. Use it as a lens. The next time you see a company skyrocketing or a market dipping, ask yourself, what is the underlying incentive? Who wins if this continues? Who is carrying the risk that no one is talking about? True financial wisdom isn't about knowing everything. It's about knowing how to think about everything. It's about building a mental fortress that protects your capital and your peace of mind. So hit subscribe so you won't miss what's next and jump straight to the next video, because that could be the very insight you need to get ahead.